Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Indian Accounting Standard 21, which deals with effect of change in foreign exchange rate. This topic we are going to discuss in two parts. That is, today we will complete some of the concepts, and in next part we will complete the whole standard. So let's start our topic. In this index we deals with the what we will going to discuss in this standard, that is the introduction of this standard, then objective of the index 21, what are the objective of this, why this index is being made, and the scope part, what are included in this index and what are excluded, definition of functional currency, which is new concept and also very important, difference between local functional and presentation currency, and the use or purpose of presentation currency, then foreign currency transaction, how to deal with change if there is a change in functional currency, how to deal with, then foreign currency operation if any, then translation of foreign currency operation if any, so how to deal with this standard says, then disposal of foreign operation if any, how to deal with, how to make a treatment of that, this standard guides us, and also the disclosure part, treatment of advance paid and received. Firstly, we make some introduction of this standard. This standard is quite different from AS11. AS11 we only make only the foreign currency transaction. There is no concept of functional currency, presentation currency, but in Index 21 we discuss the presentation currency, we discuss the functional currency, which is very important. The whole index is based on the functional currency, is emerged in Index 21, but AS11 does not talks about the functional currency separate. Standard generally deals with functional currency, the foreign currency and the presentation currency, and also the foreign operation. Functional currency is what? Is the currency is not the currency where the entity is domiciled. The currency in which the entity operates, the economic environment in which the entity operates, that country's currency is the functional currency, and presentation currency is that in which we present our financial statement, and foreign currency is other than functional currency. So we will discuss why. Example, suppose Tesla car is manufactured in Texas. It's a foreign company. So all the foreign companies operate domiciled in Texas, and it's operated from Texas, and the thought process of that company is based on the factors determined in the Texas, that is the sale, the cost and the competitor. The functional currency of that organization is the USD and not an INR. Even if the company is located, the subsidiary is located in India, but we will check the from where the company is operated. We will check the criteria factor from where the company is operated, from where the sales is determined, from where the cost is determined, and competitive market. We will check these indicators to determine the functional currency. So, and we will also discuss about in this topic that presentation currency in which we will present our financial statement in their currencies, so they will understand our balance sheet and company's balance sheet, Indian company's balance sheet, and they will then invest. So for their understanding we will prepare the presentation currency. It's not important that we will make only one presentation currency. Financial statement is presented in various currencies, but the functional currency is only one. There is no multiple functional currencies. and foreign currency is other than functional currency. I'm just giving the brief what we will going to discuss in this standard. So let's start. So firstly we will discuss the objective of this standard. This standard generally deals with how the entity apply the transaction in foreign currency in the financial statement. This standard says how the company will apply their foreign currency transactions in the financial statement. If there is any foreign operation, the company is making any foreign operation, how they will make the application in the financial statement, this standard guides us. It deals with how the entity make an application of presenting the foreign currency transaction, how the company will present foreign currency transactions in the financial statement, how they will translate the functional currency into presentation currency for the purpose of the investors. If it is required by any law to make a presentation currency, then they will prepare, and also for the consolidation purpose. So these are the objective of these standards. The transaction which the company makes in the foreign currency, how they will deal in the financial statement. If there is a foreign operation, how the foreign currency transaction is presented in the financial statement. These standards says all. Now what are the scopes? What this standard includes? This standard includes generally the accounting for transaction and balances in the foreign currency. Export import transaction. If they are importing anything from US, so how the company will deal, and if Indian companies are exporting any things to the other foreign countries, how they will deal with. So these standard includes all these transactions. And then the foreign operation that includes in the financial statement of the entity by consolidation or equity method, that is in case of subsidiary, associate, joint venture, the activity of which are based in the country or the currency other than those the reporting entry. Means foreign operations which are in case of subsidiary, associate, joint venture. Suppose one company is the holding company is located in India and the subsidiary is located in US. So how the company will deal with this kind of transactions, how the company will deal with the foreign operations. So this standard says about all this, how the company will consolidate the balance sheet. This includes in this standard. So this standard deals with the foreign currency transaction, foreign operations is there, it includes that, and translations of entities results and financial presentation into means any results. If the financial statement are there, how they will convert into the presentation currency for the purpose of the investors, for the purpose of consolidation, and if it required by any law, then they will make the presentation currency in that. That is conversion of INR into dollars. So the standard generally includes with this type of transactions. What does this standard does not include? That is, if any foreign currency derivatives. If any foreign currency derivative transactions are there, which is not included in this standard, this type of transactions are dealt under Ind AS 109. Hedge accounting for foreign currency items also deals under 109. Cash flow presentation for transactions in foreign currency. It also deals under Ind AS 7. It is not deals under by this standard, it deals by the Ind AS 7. Translation of cash flows of foreign operation and long-term foreign currency monetary item for which an entity opt for the exemption as per Appendix D to Ind AS, which deals under Ind AS 101. So these are out of the scope. What are these standard does not include the foreign currency derivatives, hedge accounting for foreign currency items, cash flow presentation for transaction in foreign currency, translation of cash flow of foreign operations, and long-term foreign currency monetary item for which an entity of for exemption. So these are not included in these standards. There is a separate standard for in order to deal with this type of concepts. Now we will start the important part of this standard. Means what the root of this standard. Definition of functional currency, which was not there in AS 11. So let's start. Functional currency is what? Functional currency is the currency of the primary economic environment in which entity operates. Means the currency in which the entity operates, that becomes the functional currency. Is to be explained by example. Suppose one is an Indian citizen, went to Europe for tour purpose. His thought process is totally based on Indian market, and he earns in India, he spends in India. His thought process is totally based on Indian market. Indian thought process is there. He went to Europe for traveling purpose of for spending his holiday in Europe. So he went there and he spent some money for train ticket. He purchased a train ticket. His thought process is based on the Indian market. He paid in euro, but he started converting in INR because his spending habit is in INR. So, but the people, this is the example where the people belongs to India and went for traveling to Europe. So its thought process is totally based on the Indian. So its functional currency becomes an INR. But the people belongs to the Europe and he spend in Europe, he earns in Europe. So that the European people who spend in Europe is not, he does not think from the Indian perspective. His thought process is totally based on the Europe market. So if he spend in euro, he does not translate in INR. His thought process is quite different. So it's all about, so his functional currency will be euro because it's earning in euro, spending in euro, is determining. It does not mean that domicile in that country is not important, but the primary economic environment in which the entity operates is important to determine the functional currency. So for determination of functional currency, we will check the primary economic environment in which entity operates. But the domicile, where the entity, where the country, the people domiciled or the entity domiciled is not important for determining the functional currency. What does primary economic environment means? Primary economic environment means the one in which it primarily generates and expend cash. That is, it earn its revenue and pay its cost. Normally the currency of a country in which the entity is located. In most of the cases, the functional currency is same as the presentation currency. In 99% cases, the functional currency is same as the presentation currency, but in some cases, there is a functional currency is not same as a presentation currency. Like we will take the example of Tata. It's a big industry. The functional currency of that, it is located in India. The organization is located in India. Its functional currency is same as the presentation currency. So even he has a many subsidiaries and all are located in the foreign market also, but in outside India also. But the root of that organization is in India. The thought process of that is organization is India. The spending habit or the earning revenue which it generates from Indian market, though they are generating revenue from foreign market also, but the root of that organization, the entity is located in India, its spending habit is India, its thought process of determining the sales cost and the competitive market all are in Indian market. So its functional currency is same as the presentation currency. More or less in 99% cases the functional currency is similar to the presentation currency. There is no difference, but in some of the cases there is a difference. That is for consolidation purpose the presentation currency is different from the functional currency, and also if it is required by any law, and for investors purpose also, if some company want to invest, some foreign company want to invest in Indian market, Indian entity, so they Indian entity need to present in order to understand their financial statement in their currency, in the investors country's currency, so they will able to understand Indian entities financial statement. For that purpose also functional currency is different from the presentation currency. So that is if the entity is located in India, then Indian currency is the functional currency. But these currency is not always same. It might be different. There may be some situation where functional currency is not the home currency. Example, this is to be explained by example. Suppose you are an Indian citizen, went to Europe for tourist purpose, and you spend some amount in train tickets and paid in euro, but your thought process based on the Indian market, Indian currency. You immediately start calculating that expense and start converting that amount which you spend on euro or dollar, and start converting in INR, because your thought process belongs to uh, Indian currency, Indian market. But if you are working there, you are an Indian citizen, and you are working there from last 2 3 years or 4 years, and then your thought process is quite different. You will not calculate from Indian perspective, you will Europe perspective. You will not start converting that expense into INR, because your expenses, income, all are in the country where you are domiciled. Because you are domiciled in Europe, your thought process belongs to the euro, not in INR, not in Indian currency. So it all depend on the thought process. So there may be some situation where your functional currency is not the home currency, because you are an Indian citizen. You are not there for traveling purpose, you are there permanently, because you are doing service there, so you are staying there for last 3 years, last 3 4 years, so thought process change from Indian perspective. So that is the difference, why the functional currency is different from the home currency. In some of the cases there is a difference. How we will indicate, how we will get to know that it's a functional currency? There are some indicators through which we get to determine the functional currency. There is some indicators, there is a primary indicator, there is a secondary indicator, and if both the indicators clashes, then we will take the decision from then management will take the decision which currency they will take into consideration for their financial statement. So these are, let's start the indicator, how we will check out the functional currency, how we will determine the functional currency by following these indicators, which is the rules of these standard to determine the functional currency. For determining functional currency, the standard put emphasis on the currencies that determine the pricing of the transaction by using primary indicators or secondary indicators. If both the indicators has a tie, there is a clash between the primary indicator and secondary indicator, then the management will decide what becomes their functional currency, rather than the currency in which those transactions are denominated. Means merely invoicing in a particular currency is not important. If you are making the invoice of any of a transaction in USD, does not determine the functional currency. It's an indicator which is set by this standard, which is guided by this standard to determine the functional currency. There is some indicators, that is the primary indicator and secondary indicator. If that indicators does not help, then the management will take the decision, and if the management will not take the proper decision, then the auditor will check whether the management has taken the proper decision, whether the management has selected the proper functional currency for their financial statement. Like, it may be possible that the management may also go wrong in determining the functional currency. Then the auditor have to look at by following SA 315, that is the risk of management biasness, that which consider the implication for the audit. So in this way the functional currency is determined. So let's start. In order to determine the functional currency, the standard guide does the sum of the primary indicators. There are three primary indicators. The currency which that mainly influence the sales price for its goods and services. Often the currency in which the sales price are denominated and settled. Means the currency which influence the sales price of for its goods or services. That becomes the primary indicator. That becomes the primary indicator. So sales price becomes the primary indicator. We will check in which currency we will selling our product. The entity sells its product. The currency that influence the sales price. Denomination is not important. Influence the sales price is important for determining the functional currency. All the products which you are manufacturing, which an entity manufactured, according to the thought process of the Indian customers. If the manufacturing unit are in India, then they will decide the sales price by the purchase power of the Indian customers. So that becomes the functional currency. So the customer, whether the customer will accept that price or not. So sales price is one of the indicator to determine the functional currency. And also the cost. The cost which the company is paying for suppose currency, in which currency the company is paying its cost, like paying its labor cost, its material cost. That is also one of the important indicator to determine functional currency. So one indicator is the sales price, the second indicator is the cost, and the third is the competitive forces. Competitive market and regulations also determine the functional currency of a entity. So currency of the country whose competitive forces and regulations mainly determine the sales price of its goods and services. Means the government will determine competitive forces and regulations determine the sales price of its goods and services to which the entity belongs, is also the primary indicator. There is a clash. If the sales price competitive forces, and the cost. There is a clash between these three indicators, then the company will follow the secondary indicator. This is to be explained why there is a clash. Suppose the company, Indian company is there, or Indian companies, the entity, all its expenses is operating expenses, is labor cost, material cost, all the cost is salary, rent, indirect expense, all are paid in INR. So cost is based on the cost is, all the costs are paid in INR, but the sales, the seller, the customer of that organization, which is an Indian entity, is belongs to a US market. So all the revenue which the company generates are in USD. They make an invoice in USD. So there is a clash. Costs are in INR but revenue in USD, and competitive forces are in USD. Based are in USC. So there is a clash between these three indicators. Which indicator the company will select? So then they will go for the secondary indicator. If there is a clash in the sales, in determining the sales price of the goods, in determining the cost, and in determining, finding the competitive force and regulation, then they will look into the secondary indicator. Secondary indicator, how the entity will check how this standard says, what the standard says about these indicators. The currency in which the fund from the financing activities are generated. Means from which currency you are generating the fund, you are taking the loan. Your IPO belongs, the company's IPO belongs to which currency? Equity belongs to which currency? If it is belongs to the INR, then the functional currency will be INR, and if it belongs to the USD, then it becomes the USD. Then the second one is the currency in which receive from operating activities are usually retained. Means cash from operation are in which currency? Generally, operating activities in cash flow will check that all the cash flows, all the expenses, the revenue which are generating, then we will reduce from that non-cash item. Then the item included in the financing and investing activities, we will make the adjustment, we will make the working capital adjustment in that. The debtors creditors differentiation, in which currency these kind of transactions are operated, and the operating cash flows are retained in which currency, that is also an important indicator to find out the functional currency. So these are the indicators. First is the primary indicator. If there is a clash, then we will go for the secondary indicator, and if we will not able to determine the functional currency by using the primary and secondary indicator, then management will decide which functional currency they will take into consideration for preparing their financial statement. Where there is a tie on primary or secondary indicator, or both the indicators are mixed and the company unable to determine functional currency, then the management will decide by using its judgment to determine the functional currency. Management has to check how the management will determine that which currency they will take into consideration. Management has to take firstly the primary indicator. If not possible, then go for the other indicators, which are designed to provide additional supporting evidence to determine an entity's functional currency. What was the other indicators? Other indicators means the management will see whether the profitability or profit ratio of the entity are in INR or USD. They will check whether the profitability or profit sharing ratio, profit ratio of the organization is in INR or in USD to determine the functional currency. Then what they other condition they will check, other factors, they will check the retained earning. What were the retained earning of an entity are in INR or in USD. The thought process of the company, that whether what was the thought process, they are thinking by the perspective of USD or they are thinking by Indian perspective to determine the functional currency. Then what the management will see, management has also moved to a favorable currency, means which yield foreign exchange gain in order to improve entities profit. Management also decide which currency will gain, which currency is beneficial for the organization's improvement, organization's growth. That currency they will take into consideration as their functional currency. So these are the conditions, factors which they take into consideration while taking decision for determining the functional currency. And if the management go wrong in their decision, then the auditor, while doing the audit, they will look all the perspectives, whether the management has taken properly the selected the proper functional currency. So by following SA 315, so what implication they will check while doing an audit? What implication the auditor will check? They will check the way how the costing is determined, in which currency the costing is determined, the manner in which product profitability is determined. The auditor will check all this, the manner in which currency the profitability, the product profitability is determined, the sales price is determined. The auditor will also check the in which currency the sales price is determined. What are the factors for determining the sales price of the product of an entity? In which currency the company determine its selling price? The rate of return. What was the in which currency the company is expecting to get the rate of returns? In which currency the company will satisfy all its condition. So the auditor will check. In this way the auditor make an assessment whether the management has correctly determined the functional currency. And this gives us a guidance, proper guidance, how they will find out the functional currency. These functional currencies explained via example. S Private Limited is a subsidiary of B Private Limited. Takes order from an Indian customer. S Limited takes order from an Indian customer and then bills and collects for the sales of merchandise in rupees. Means they make their bills in rupee terms. S Private Limited has a local warehouse in India to facilitate the timely delivery, but all its collection it remit to the B Private Limited. Cash flows which it generates, it remit to its parent company, that is B Private Limited, which is a foreign entity. And all the expenses of the operating expenses of the S Private Limited are financed by the B Private. Private Limited does not have any power to make decision. S Private Limited only has to collect goods from B Private Limited and sell to the Indian customer and make invoices in Indian rupees. And all the collection which he has made, he transfer the money, all the collection cash flows to the B Private Limited, and all the expenses which the S Private Limited incur is borne by the B Private Limited, which is a US based company, and its functional currency are also in USD. What was the functional currency of the S Private Limited? So we will illustrate, we will check what was the functional currency. B Private Limited functional currency is USD because it is based in the USA. It's a US based company, so its functional currency is USD. as the company is located and domiciled in US. It's okay. S Limited is the subsidiary of B Limited who work according to the B Limited conditions. Means S Limited does not take decision of its own. This company S Limited works according to the direction given by the B Limited, B Private Limited. So the S Private Limited, what it's do? It's take order from Indian customer of the goods which belongs to the B Private Limited. Means S Limited does not have its own goods. All the goods which the S Private Limited sold, it belongs to the B Private Limited. S Limited only take orders from customer from Indian market and make bills and remit cash to the B Private Limited. So it's as all the expenses of S Private Limited is to be borne by B Private Limited. According to these explanation, we came to understand that S Private Limited works according to the guidelines given by the B Private Limited and also does not have power of independent decision making, though its customer are located in India. Though the customer of S Private Limited are located in India, sales are also done in India, but the goods belong to B Private Limited and its decision power are in the hand of B Private Limited. And product pricing is determined by Private Limited according to their thought process. So the functional currency are in USD. If you like, please subscribe my channel. Please share my channel. Thanking you for watching my video, and in next video we will complete our Ind AS 21.